Hello and welcome to Sectors Up Close. I'm Vincent McAviney. Our focus today is on investing in Canadian equities, and our guest is Paul Bowes, FTSE Russell's country head for Canada. While Canada is the world's 9th largest economy, its GDP is still about 1/10 of its much larger southern neighbour. The total market capitalisation of the top 300 companies that make up the Toronto Stock Exchange is about $2.5 trillion, so less than the value of Apple by comparison. The market has underperformed the US market in the past few years, but some analysts say this represents an opportunity as many of the companies based there are considered value plays. This is one ETF that tracks Canadian equities as measured by the FTSE Russell Canada Index. As you can see, it's dominated by banks, railways, energy, and Canada's e-commerce darling, Shopify. Aside from Shopify, all are companies that may benefit from an environment of not only higher commodities prices, but also higher interest rates. So what is the outlook for this market? Let's ask Paul Bowes of FTSE Russell Canada. Paul, thank you so much for joining us today from Toronto. So why have Canadian equities underperformed?
Well, Vinny, thank you very much for having me. First of all, we, of course, are one of the world's leading index providers. And so just as a quick caveat, I am not in the business of making predictions. I'll let your viewers talk to their advisors about that. But we can certainly give you a sense of what has happened to date. And I would say there's two factors, Vinny. One is that Canada probably imposed stricter COVID restrictions than the United States. That might have restricted the economy more, the equity markets. But I think probably more importantly, we are very much dependent on oil over the last couple of years, and in particular the last 5 years, the low oil price. You may remember just at the very same time as the COVID restrictions were occurring, OPEC was having a fight, Saudi versus Russia. And I would say that may be a factor. And the reason I feel that, Vinny, is because in the last few weeks and months, the Canadian market has recovered quite significantly compared to the United States. And I think that might be because of the rise in oil prices.
And like the rest of the world, Canada is in a period of high inflation. How will this affect the outlook?
Well, again, I would say, in my opinion, I think that the data substantiates that high inflation is potentially a good thing for Canada. And I'll tell you why. Obviously, equity markets are always negatively affected in the broad range. But we are a commodity-based economy, which is often seen as a natural hedge against inflation. And also our financials, our strong presence and our strong banking sector can benefit potentially from as rates increase. And then finally, look, as our markets move to a higher inflation market, that is, as you said already, Vinny, a growth to value. The US has benefited over the last few years with their technology sector. That may be, coming to a slight pause, whereas commodities, financials, strong markets for Canada could see improvement.
And within this space, as I mentioned, you have financials, energy, railways. Which, in your opinion, will do best?
In my opinion, the data substantiates. I feel that financials is the area that I think has the greatest opportunity. I'll tell you why. I think that oil prices have risen. That might be for a variety of factors. The economy is recovering. But as I said, I think our strong banking sector, which historically has been stronger than the United States, I think is in my personal opinion, a stronger sector.
And so will the market do better than the US this year, do you think?
Well, now that is definitely a prediction I'm not prepared to make. I would just say, though, that the United States economy, as you pointed out, is 10 times bigger than our own. Our global indexes are heavily influenced by anything to do with the US market. But as inflation rises, as we come out of COVID restrictions, I do feel your opening point is a valid one, that countries like Canada, I think, do potentially provide an opportunity for this shift from growth, the tech stocks in the United States, to value. Solid banks and an energy economy, which is what we are, with relatively higher oil prices.
Paul Bowes, country head at FTSE Russell Canada, thank you very much.
Thank you.
Before I go, here are some of the top stories in this space. Police in the Canadian capital city of Ottawa have warned protesters there to abandon their occupation of the downtown core or face arrest as they try to end a 3-week-long protest over COVID restrictions. The city's interim police chief said the force would take back the entire downtown core in the coming days. And the federal government's public safety minister has accused extremist groups of helping organise the protests, which also closed border crossings affecting billions of dollars in trade with the United States. The government earlier this week invoked rarely used emergency powers to stop foreign financing of the protesters and prevent further border closures. E-commerce giant Shopify forecast a slowing pace of revenue growth in the first half of the year. It also said it was ramping up spending on its network centers. The company's forecast said the e-commerce boom caused by the pandemic was cooling as more shoppers returned to physical stores. Its shares fell 18% on Wednesday. The Deputy Governor of the Bank of Canada said the central bank will be, quote, forceful in fighting high inflation. Timothy Lane told a university audience that there is a risk inflation would continue to be more persistent than forecast. Canada's annual inflation rate hit a 30-year high of 5.1% in January. That's the 10th month it's been higher than the Bank of Canada's target of 1 to 3%. And that is it for your look at investing in Canada. I'm Vincent McAviney, and this is Reuters.